What's up, everyone? It's Scotty with Money Investing. So the employment report just came out literally an hour ago. So I wanted to break this down as much research and reports I was able to find. I'm going to break that down exactly what that means for the market. Markets are closed today, but they are going to be open on Monday and they are going to react to the employment report from today. So I hope you guys enjoyed this video, find it helpful. If you do, make sure that you drop a like. Don't forget to subscribe to the channel if you're just joining us for the first time. The link to our Discord and Patreon is going to be down below. Usually the first week of the month is the best time to join, so you can access all the buy and sell alerts, options alerts, trade ideas, all the member benefits, including private videos as well. And we also do have the fundamental and technical analysis courses. Currently, the bundle is 60% off, and the coupon code is going to be Easter, and that is the Easter sale as well. So this right here is going to be the employment situation. So we did get a very nice miss on the employment number, meaning that we were expecting for the non-farm payrolls to increase by 240,000. Instead, we increased by 236,000, and unemployment rate did tick lower from 3.6 to 3.5%. And private payrolls did increase 189,000, with participation rate slightly increasing to 62.6%. Average hourly earnings grew 0.3%, and on a year-over-year basis, they're up to 4.2%, which is lower than 4.6% from the previous month. And the average work week also did decline by 0.1 hours, or came down to 34.4 hours. So on the surface, I mean, this may seem like a very strong labor market, and I did also mention it in our Discord right after the report came out. But looking a little bit more closely, it's not really that strong, because a couple things. Number one, the leading indicator for a potential recession in the economy, or at least one of the leading indicators, is payrolls, but for specifically two categories, which I've mentioned in my previous videos: manufacturing and construction, right? These are very, very important categories for economic growth. If you take a look at the last 12 months, almost all sectors have grown in terms of jobs. So mining and lodging, we've got construction, manufacturing over here, wholesale, retail trade was down by 15,000, but transportation, utilities, IT, financial services, you get the idea, right? Services, government services, everything's been growing. Last 6 months, the picture is more or less the same. We've seen a lot of growth in a lot of sectors in the economy. The last 3 months, again, a very similar picture, right? Every single sector is growing. However, if you take a look at the last 1 month, in other words, the previous month, for the month of March, for which we just got the report, two sectors now turning negative are indeed construction by 9,000 jobs, and we've got manufacturing also turning negative by 1,000 jobs. If you come over to this chart, which is basically employment by industry, if you go over to this one, and if we simply just remove everything and just go over to construction, you'll start to notice that construction starts to lead ahead of a potential recession. If you can see, kind of scrolling in right now, you can see that we are starting to stabilize a little bit. So we have come down from 7.89 million down to a little bit under 7.9 million. So we are stabilizing, and it's not, again, I don't want to make a big deal out of it because it's happened before. So we have seen a bit of a softening in the labor market with respect to construction back in 2021, when we came down from 7.6 to 7.59. So we did see a little bit of softening, and then again exploded a little bit to the upside. But one thing to consider back then was that we were still seeing a lot of QE. We were still seeing a lot of quantitative easing, and the Federal Reserve was also printing a lot of money. They were buying a lot of mortgage-backed securities, treasuries. They were pumping the economy with a lot of money. In other words, forcing a lot of companies to borrow and build. And that was obviously a big reason as to why construction employment just continued to supercharge higher to where we are now. But now we're in a tightening market, and you're seeing that with manufacturing as well. It is now starting to stabilize a little bit. You'll notice that we are starting to go sideways, not really growing on this linear path anymore. Another thing that I wanted to mention, which was quite interesting, is the idea between skilled versus unskilled labor. So this is a good chart that pretty much I found on Twitter that suggested the U.S. employment population, which is a ratio between unskilled labor. And again, I don't like to use unskilled versus skilled because, you know, every job requires some level of skill, right? Every job requires a different type of skill, right? Whether you're in construction, whether you're in IT, whether you're in financial services, every job requires different level of skill. So I don't necessarily like to call this skilled versus unskilled, but this chart is really representing jobs that require a degree versus jobs that don't require a degree, right? The ones that can be done with a high school diploma versus that require proper undergraduate master's degree sort of thing. So what you'll notice is the employment population with respect to jobs that don't require any professional degree and just a high school diploma has been going higher. And the other part, which is the jobs that do require an undergraduate or a graduate degree or a professional degree, has been going lower more recently. So you're seeing that divergence kind of play out in the economy, and at the same time you're starting to see average hourly earnings also weaken on a year-over-year basis. They have been trending lower since March of last year. So the bottom line is that this employment report, on the surface, yes, it may seem like it was a good print, and unemployment did come down to 3.5% from 3.6, and that's great. I mean, on one hand, you've got the market's expectations now switching over to a more hawkish Fed. So if you come over to the current probability number, we are now 70% pegged for a 25 basis points going into May, which is going to put the target range at over 5 to 5.25%. We're going to stay there for the next couple meetings. That's at least what the market's expecting. And then a total of 9 cuts priced in from a QE perspective from the market. So this again has been switched a little bit. So we're expecting 9 cuts. 1, 2, 3, 4, 5, 6, 7, 8, 9. 9 cuts expected after another 25 basis points hike in May. But this only sort of alerts everybody to keep a close eye on what's going on with construction and manufacturing payroll, because those are some of the leading indicators, as I've already pointed out in my previous videos, of potential recessions. Now going over to the futures, right now we've got NASDAQ futures pretty much flat, and S&P 500 futures are slightly higher, up over 25 basis points. So the markets are open for them. And we got the 10-year yields pushing higher, also up close to 2% after the news came out. And we're pushing past 3.5% once again. So in my opinion, with this strong labor market, which does seem like it's strong on the surface, this gives the Fed a little bit more flexibility to raise rates and be more hawkish in their tone, which in turn could not be super great for stocks going into next week. And also keep a close eye on potential recession indicators with respect to construction, manufacturing, jobs, average hourly earnings, the difference between skilled versus unskilled labor, and of course tech layoffs that are happening on a more regular basis, and other indicators that will also follow up with an earnings season starting later this month. So hope you guys enjoyed this video and found it helpful. Let me know your thoughts on the entire jobs report. What did you make of it? Right now the market's not very reactive, but the 10-year treasury is definitely pushing higher, close to 2% at the moment. So as always, make sure that you drop a like, subscribe to the channel. Link to our Discord and Patreon is going to be down below. Happy investing, and I'll see you all in the next video.